Hello children, welcome to the digital classes of Christchurch Convent Higher Secondary School Gadarwara. This video is for class 12th. Subject is economics. Chapter number 3, money and banking. First topic of this video is credit control policy. RBI giving directions and using its power make over a control on credit creation by commercial banks. So it is divided in two categories. First, quantitative instruments, and second is qualitative instruments. First, we shall study quantitative instruments, and first point of this is repo rate. So first, let us understand the meaning of repo rate. Repo rate is the rate of interest at which RBI lends money to the commercial banks. Commercial banks take a loan from RBI so that they can consolidate their liquidity position to win the trust of people in banking system of nation. At times, RBI vary this repo rate and it puts a greater impact on the credit creation capacity of commercial banks. This is a tool by which RBI keep a control over the supply of money, means either it can increase or can decrease. And when it is, means what happens when there is an increase and decrease in repo rate? When RBI increases repo rate, so commercial banks are discouraged to build their cash reserves. It means they cannot take loan from RBI, and thus the supply of money is decreased. So increasing the repo rate is a prominent tool, and it's actually alarm to the commercial banks to maintain their rational reserves of their vault cash. If vault cash increases, then the capacity to create credit is reduced, or you can say the supply of money is reduced. When repo rate is increased, market rate of interest, it is also increased by the commercial banks, and thus the demand for loan by public is reduced by the industrialist, by the household and others. Consequently, the investment expenditure and consumption expenditure also falls. In simple language, you can say that the demand for goods and services in the economy falls. So, through which the state of inflation is corrected. Whereas when the repo rate is decreases, so that encourages commercial banks to build their cash reserves by the way of borrowing from RBI. They can take loan from RBI, and thus it enhances the capacity of making credit creation by commercial banks for the public. So they need to keep their vault cash low, and that gives a room to commercial banks to make credit, to offer loan for the public, and thus the state of deflation is corrected. Second point is reverse repo rate. So first understand its meaning. Reverse repo rate is said to be the rate of interest at which the commercial bank can park their surplus funds with the RBI, through which they generate a fixed income in the form of interest. These funds are not at all concerned with legal cash reserves of the commercial banks with the RBI, means CRR, that is cash reserve ratio. So what happens when reverse repo rate is increased? When RBI increases the rate of interest on the deposits by the commercial banks, so it encourages commercial banks to keep their money safe with RBI and to receive a certain income in the form of interest. Thus, the capacity of making credit creation reduces and supply of money is reduced in economy to curb inflation. And second is decrease in reverse repo rate. When interest on deposits provided by RBI to the commercial bank is low, so commercial banks, instead of keeping their money as deposits with RBI, they would prefer to provide it as a loan to generate some income. And then these banks use these funds as CRR funds, and they increase creating credit. So resultly, it increases money supply in the market and deflation can be curbed. Fourth is bank rate. Bank rate is that rate of interest at which the RBI lends money to commercial banks without any collateral security. Collateral security means no mortgage is kept by commercial banks with RBI. Normally, it relates to the borrowings by commercial banks to meet their immediate cash crunch. So this is an objective, the last line of the first para. Bank rate is generally higher than the repo rate. Now we'll see the effect of rise in bank rate. When there is a rise in bank rate, so commercial bank will not ask for a loan from RBI, and they are discouraged because RBI is charging higher bank rate, and it reduces the supply of money by commercial banks as desired, so that the inflation, the state of dearness can be curbed. When bank rate is increased, so it play an alarming role to the commercial banks to increase their own reserves. They cannot they cannot request RBI to give them loans, and thus it reduces the credit creation capacity, and there is a cut in supply of money by commercial banks, so that the state of inflation can be removed. And vice versa, when we talk about, on the other hand, what happens when there is a decrease in bank rate, so all the commercial banks will seek a chance to receive a loan from RBI, and they need not to keep their vault cash at higher. So that excess amount of money means their own self vault cash plus the grant received by loan received by RBI, received from RBI. So these two can be used for making credit creation, and it enhances the capacity of commercial banks to make credit creation, to provide loans to the public. And thus there is the higher demand of goods and services in an economy, through which the state of deflation can be curbed. There is a difference. It comes in examination for 3 marks, so you must learn these 3 points. Difference between bank rate and repo rate. So first, collateral security for loan. Bank rate relates to the loans given by RBI to the commercial bank without any collateral security. And repo rate, it is the same, not without collateral security. Sorry. Then second is nature of rate. Bank rate is simply the rate of discount, and repo rate allows repurchase of securities. The holder can repurchase securities at a later date repo rate, and it is called repurchase rate. Purpose of borrowing. Bank rate is related to borrowings by the commercial banks to cope with their immediate cash crunch, and repo rate is related to short-term borrowings by the commercial banks. So this is all for today, and in the very next chapter we shall discuss about qualitative measures or qualitative tools by RBI. One more is there, cash reserve ratio, that is CRR. It is the ratio between cash reserve of the commercial banks with RBI and their demand deposits. So this ratio is fixed by central bank, and it is revised time to time so that it can make appropriate supply of money in an economy. So there is a formula for this. Credit multiples is equal to 1 upon CRR. Higher CRR means lower value of credit multiplier, and lower CRR raises the value of credit multiplier. So what happens if there is a rise in CRR? Rise will put an inverse effect, that is fall in the value of credit multiplier. It means fall in money supply of commercial banks, through which inflation is curbed. See, all these are the weapons, or you can say the corrective measures for inflation and deflation. And fall in CRR will rise the value of credit multiplier, and therefore there will be a rise in money supply of commercial banks, and they can make more credits, so deflation is curbed. The next is statutory liquidity ratio, that is SLR. So this is the ratio between liquid assets of the commercial banks and their total deposits legally required to maintain on daily basis. So in liquid assets, there are three things are included. First is cash, second is gold, and third is unencumbered approved securities. So SLR is also fixed by RBI, which is varies, means it is keeps on changing time to time. This is a significant policy ratio which is used as a weapon of monetary policy. When there is a rise in SLR, so it means there is a rise in liquid assets held by the commercial banks, and they will have shortage of funds available for CRR and deposits for the creation of credit. So the ultimate result is fall in money supply of commercial bank to curb the inflation. On the other hand, when there is a fall in SLR, so it means fall in liquid assets held by the commercial banks. This will result rise in funds available for CRR and deposits for the creation of credit. And the ultimate result is rise in money supply of the commercial banks, through which demand can be given a room, a pace, an impulse, and deflation, the state of deflation, can be removed. So this is the end of video, and means in the next video we shall discuss about qualitative measures. Thank you.